Good Monday morning, everyone, and welcome to NYSE TV Live. I'm Kristen Scholler here at the Stock Exchange. We start a busy week together, as we always do. And over the next few days, the Federal Reserve's latest meeting, as well as technology results from major companies like Apple and Microsoft, will drive what's ahead. Well, traders by and large anticipate no interest rate cut from the central bank on Wednesday in its first policy decision of 2025. They will, however, be listening to what the Fed chair has to say about the path forward for rates. Now, of course, it depends in part on how sticky inflation is and the health of the labor market. Let's take a look at what's on tap in today's show. As the S&P 500 sits near a record high, Anthony Scaramucci, founder of Skybridge Capital, will join me to talk markets. Plus, Similarweb, a global software development and data aggregation firm, will join my colleague Trinity Chavez with an update. And as rain has fallen on Southern California, we'll continue to highlight the stories of support to the communities most impacted by the wildfires earlier this year. But first, let's turn to how the trading day is setting up on Wall Street and what's ahead. Joining me now with more is Anthony Scaramucci, founder and managing partner at Skybridge. Anthony, welcome.
Good to be here. Good morning.
It's great to have you on the show this morning. And as we are coming off back-to-back weekly gains for the S&P 500, how does the market look to you?
Well, I mean, we're probably overdue for a correction. I mean, we haven't had a correction. I think it's just over 20 weeks now, a significant correction. And so it wouldn't surprise me if the market corrected a little. But having said that, we're very bullish on this year. Our year-end targets are plus 15 for the S&P 500. Obviously, we have a very large crypto position, which we're optimistic about as well. And even though the Fed is signaling that they're not going to cut rates, we do believe you'll get at least 2 rate cuts this year, possibly 3. And so there's reason to believe that the market will maintain its buoyancy. Now, of course, we've had this AI scare, which I think will be short-lived.
I do want to talk more about the optimism that you see, plus 15% on the S&P 500, a double-digit gain, Anthony. That definitely is optimistic and does join other optimists, I think, on Wall Street in terms of the view. Now, when you look at rate cuts, you anticipate 2 this year, but what else is behind the positive momentum that you see on the year for the market?
Well, I mean, again, it may or may not happen, but I don't really think it matters that much. But if you get a tax cut, President Trump is talking about taking corporate tax rates from 21 to 15. That 6% doesn't sound like a lot until you apply it to earnings in the S&P 500. It could be as much as a 15 to 18% improvement in earnings. And so if you have a combination of a tax cut, the president's also talking about a reinstallation of the state and local income tax deductions for the blue states. And so that would be a very powerful consumption-based tonic for the markets. And so what would offset that, of course, people would obviously be worried about the deficit. But I think there'll be a combination of things. Ultimately, when you look at the president's tariff proposals, you'd have to think of those as consumption tax, even though he says that the countries are paying them. What actually happens is the consumers pay them at the port as those goods come in, or the manufacturers pay them at the port. So you could see a corporate income tax reduction, slight consumption tax with the tariffs, and that blends out to a very nice earnings story for the S&P this year.
And so speaking of earnings, Anthony, of course, we are underway in this corporate reporting season for the fourth quarter results. And this week we'll hear from 4 of the 7 magnificent 7 companies. They make up a large portion of the market: Meta, Microsoft, Tesla, Apple. What do you need to hear from these companies this week?
Well, listen, the market likes rate of change growth, as we both know. The market likes, you can have a slowdown in this quarter with great foreseeability for the next several quarters. So I think those companies, though, have very big moats around their businesses. I think the idea that they were going to be potentially broken up due to their size and scale and their relative market cap weighting in the S&P 500, I think those concerns are over. It seems like the president and his team have gotten closer to the founders of those companies, frankly. And so I think we have reason to believe those companies stay intact. They maintain their aggressive earnings and share repurchase programs. And I think it's a clear, as they say in the Navy, they say cavu, the ceiling and visibility is unlimited, and it feels that way for the market. Now, that doesn't mean that we won't have corrections, which are natural, because when things are priced like this, you could have a setback or a fear, like we experienced over the weekend with the introduction of this Chinese AI product. But long term, over the next 50 weeks, I think the markets are going to be in very good shape. We're long the markets, we're long crypto, and I think we have reason to be optimistic. It's not to say that things will be perfect, but I think it'll work out well for 2025.
Anthony, to that end, let's dive a little bit deeper into crypto. You've mentioned several times here that you are bullish on this space. What's behind that?
Well, basically, there's been a relaxation of the regulatory grind for 4 years, and still, for reasons I don't fully understand, the Biden administration took a position that they wanted to be anti-crypto regulation. They wanted to slow down the Bitcoin ETF. Frankly, as we're discovering from documents that are being released, that they literally slowed down the banking accounts of crypto-related companies in something called Operation Choke Point 2.0. I think President Trump is guiding people. Presumptive Commissioner Atkins from the SEC is guiding people that this sort of stuff is going to end. Scott Bessent, who will be the Secretary of the Treasury, is pro-crypto. And I think you're going to have a regulatory environment that favors long-term growth in the cryptocurrency markets. There are some speculation about the United States adding Bitcoin to its strategic reserve. I do think that is likely. And so for that combination of those things, we have a $200,000 price target on Bitcoin this year.
Wow. So a doubling of where Bitcoin is now, certainly that would be a growth sector, Anthony, based on your projections. For investors watching, how should they compare investing in the traditional stock market versus the cryptocurrency market?
Well, I would tell investors, to try to stay with things like Bitcoin, Ethereum, Solana. Some of the smaller ones like Avalanche are also good, but for me, investors listening to your program, I would really just stay with Bitcoin. And I would say to those investors that this is an emerging technology that should trade to the market capitalization of gold over the next 10 years. And so Bitcoin has sort of a $2 trillion market cap. Gold has an $18 trillion market cap. And as the younger people start to age into their mid-40s, I think they'll accept this digital asset as a store of value. And so as that happens, we see Bitcoin trending, frankly, to $500 to $1 million per token. Won't happen overnight, but this is something that we've seen in things like NVIDIA or Apple. As things get adopted, they scale very quickly, and I think it's important for people to own, even if it's just a small amount of Bitcoin, to have it in their portfolios.
Anthony Scaramucci, founder and managing partner at Skybridge. Anthony, thank you.
Good to be on with you. Thank you.
All right, well, stay with us, because up next we will continue the conversation on money. In this case, how you should think about your finances in a relationship as we approach the month of February. We'll have more on the other side.
So Brightwave is an investment research platform that uses artificial intelligence to help asset managers understand more about the markets than is humanly possible.
And what would you say that makes you unique, though, from others who are currently on the market?
A number of things. So we have an incredible engineering team. So for myself, I established and led the language model engineering practice at Databricks. Created the first language model to demonstrate that open source technologies could exhibit the kinds of behaviors we've come to expect from ChatGPT. My co-founder is the former CTO of a federally regulated derivatives exchange and clearinghouse. It is.
Yeah, it's really amazing.
And his first deep learning patent was filed in 2018. We've got engineers from Meta and Instagram, award-winning research engineers, commercial team from UBS and McKinsey and Goldman Sachs. It's a stacked bench, and it has allowed us to execute on very, very difficult technical problems. If you think about the number of factors that are relevant to an investment decision, it exceeds the limits of a person's ability to keep it in mind simultaneously. And we see an opportunity with language models to create a technology that allows a person to connect the dots across millions of documents and see a story that nobody else has noticed in order to identify a mispriced asset.
And you decided to come to Money 2020 this year because you had a major announcement about your Series A funding.
That's right.
Yeah.
We have announced a $15 million Series A, preempted by Decibel Partners, one of our seed stage investors, and including participation from Omers Ventures. We're extremely excited about this. This brings our total funding in the past 17 months to $21 million. We've quadrupled our revenue since our Series Seed announcement in June or July, forget exactly when. And it's happened quickly. We've seen vigorous traction, brisk demand from across financial services.
Good morning and welcome back to NYSE TV Live. I'm Kristen Scholler. Well, with Valentine's Day approaching, it's a good time to talk money and love. And for more, I want to bring in my colleague, Trinity Chavez. Trinity, good morning.
Hey, Kristen, good morning. That's right. Money and relationships can be a tricky combination. And a very new Bankrate survey shows that 40% of couples have dealt with financial infidelity, everything from secret spending to hidden accounts. And with Valentine's Day coming up, it's the perfect time to talk about money with your partner. Joining us now to share more tips on navigating finances as a couple is Bankrate's senior industry analyst, Ted Rossman. Ted, it's great to have you this morning.
Good morning. Thanks for having me.
So let's just jump right into this conversation. I have to say, I've been so excited to talk to you about this. What would you say are some key benefits of the quote, yours, mine, and ours approach to managing finances in a relationship? And why do you think it's growing in popularity among younger generations?
This is the idea of keeping at least some of your money separate from your spouse. In fact, 6 in 10 people who are married or otherwise living with a partner keep at least some of their money separate. The key, though, is to be honest about it. So if you and your spouse agree that you each get a certain dollar amount or a certain paycheck or a certain percentage of every paycheck that's yours and yours alone, that's fine. We don't want to go into the secrets. I mean, that's the financial infidelity piece, when people are truly hiding something. But more and more couples, especially young adults, are agreeing to keep at least some of their money separate. It gives people more independence. You feel like you have more say over your money. You can buy gifts without somebody looking over your shoulder. You can spend on hobbies and nights out with friends and feel like you're not subsidizing the other. Having some money separate fosters independence. You just want to be honest about how much money that is.
Now, Ted, with about 40% of adults in the United States and live-in relationships admitting to financial infidelity, what are the most common types of money secrets and how do these impact relationships?
Secret spending is number one, and that's followed by things like secret debt, secret credit cards, and secret bank accounts. The reason this is so important is, well, one, it can undermine trust, and that's really significant. Sometimes that actually ends up being even worse than the monetary side of things. The other part is the monetary side of things, which is, let's face it, it's hard enough to meet your financial goals when you're pulling in the same direction, and it's so much harder when people are each doing their own thing. I would urge people to have conversations with their spouse about money. And ideally, you're going to go beyond just the block and tackle stuff about, oh, what bills are due this month. Ideally, you're going to talk about money values and goals. And that's really what you want to achieve with money in the next few years. Buying a house, let's say, retiring early, helping your kids with college. When you frame it that way, it's not so much about a budget being a way to deny this purchase and that purchase, but rather, okay, where do we want to go? How are we going to get there? How can we work together?
And according to the data, about 88% of Gen Zers in live-in relationships keep at least some of their money separate from their partner. Do you see this as a positive shift toward independence, or does it raise concerns about trust and communication?
It can be positive as long as people acknowledge what's going into that separate fund. What we don't want are the secrets. Gen Zers are the most likely to be committing financial infidelity. They're also the most likely to say that financial cheating is at least as bad as physical cheating, which is interesting. So they're doing it more, but they also say it's harmful. A lot of young adults are having trouble meshing their money personality with someone else's because a lot of people are getting married later now. They have their own income. A lot of people are just kind of doing their own thing. And it is important to communicate and get on the same page because whether you decide to completely combine your finances or not, that's a personal decision, but you need to work together in some respects, and you need to find something that works for you.
And Ted, Valentine's Day is just over 2 weeks away. It's coming up very quickly at a time when couples are often feeling pressure to spend money on their significant others. So what are some of the tips that you have for open conversations about financial expectations while still celebrating the holiday meaningfully?
It's important to set that budget and figure out what works for you. A lot of people have credit card debt. Half of credit card holders, in fact. And this is the time of year that a lot of people get those holiday bills and they really want to prioritize debt payoff. I would say get a 0% balance transfer card. Avoid interest on those pricey credit card bills for up to 21 months. Maybe cut back on some discretionary spending. Don't dig the hole any deeper. Everybody's financial goals and situation are different, but those fundamentals include boosting your savings. I like the idea of transferring money automatically from every paycheck into a dedicated savings account. Paying off debt, maybe with the help of a 0% balance transfer card, and just being really diligent about where your money is going. You want to carve out some fun money, but you want to make sure that you have a realistic budget. And really the essence of personal finance is living on less than you make.
But you know, Ted, it's not always about how much you spend. It's about the experience as well. I'm sure that there are many gifts out there. Making a breakfast in bed or a home-cooked meal at dinner time could make the day very special, don't you think?
Good point. Yeah, there are a lot of experiential gifts that don't need to cost a lot of money. I know it's winter, so it's trickier than it is in the summer when maybe it's easier to have a picnic in a park or go to a free movie or something like that. But yeah, there are definitely ways to have fun on a budget. People can get creative. That's one of the ways that you can use the internet and social media to your advantage, is kind of sourcing some of those fun ideas. Now, online can also encourage us to spend, and sometimes social media gets people into trouble. But yeah, there are definitely a lot of ways to have fun on a budget. A lot of people are interested in that sort of thing, especially now. The first quarter tends to be when a lot of people really buckle down and they try to pay off those credit card bills that they accumulated during the holidays.
Well, a lot to look out for. Thank you so much for joining us, Ted Rossman, Senior Industry Analyst of Bankrate. Now we're going to take a quick break, but when we come back, we're going to find out how one company is revolutionizing the checkout experience for shoppers.
So Colleen, you joined Planet Fitness as CEO in June. So tell me about your first 6 months.
It's been a very fast first 6 months. I really leaned into spending time in our clubs and getting to know our franchisees, talking with our club team members and seeing how our members utilize our clubs. I call it feet on the street. It's been really insightful. And we've also worked on our strategic imperatives and kind of codified our roadmap for our growth ambition.
So tell me about your growth strategy and vision for the future of Planet Fitness.
Our 4 strategic imperatives really start with refining our brand promise and then making sure we pull that through in our marketing messaging. We're also leaning into member experience to make sure that we're connecting with our membership and enhancing our relationship with our members and delivering a format both inside and outside the clubs that's most meaningful for them and is going to enable them to accomplish their fitness goals. And then we lean in on format optimization and our equipment mix. And that's making sure that we've got the right mix of equipment for how our members want to utilize our clubs today. And when we get all of that right, and we're thoughtful about unit economics and build cost for our franchisees, it enables us to turn up the afterburners on growth.
Now, how will you redefine your brand strategy and communicate it effectively?
We're growing stronger together, and we're all strong on this planet. We're seeing across generational cohorts a focus on utilization of strength in our members' workout routines and our prospective member workout routines. So as we've done consumer testing and consumer surveys, as well as how we've seen our members utilizing our clubs, we've recognized the opportunity to kind of shift our mix a bit and have a greater complement of strength in our.
Welcome back to NYSE TV Live. I'm Trinity Chavez in studio at the New York Stock Exchange. Now, streamlining the online shopping experience has never been more important, and Bolt is at the forefront of making checkout faster, easier, and more personalized for millions of shoppers around the world, with big plans for 2025. And I recently sat down with Justin Grooms. He is the CEO of Bolt to talk more about what's next.
Bolt has been around for, like you mentioned, a little over a decade. We have some of the largest enterprise merchants in the United States, multi-billion-dollar merchants like Revolve, a lot of other famous, well-known household brands. What we've seen over that time and the 80 million shoppers that are in Bolt's network is that we can provide identity in an accelerated solution to large merchants while allowing those merchants to maintain their own brand identity and not have to share a buying experience with some other third party. That's been revolutionary in this space, where so much of the checkout space is focused on people adding buttons or other brands, and instead we're enabling these large enterprise merchants to really highlight their own brand but provide that accelerated and quick checkout solution that consumers expect.
Can you talk to me more about how you go about customizing that checkout experience through the use of AI in your technology?
Absolutely. So with over a decade of data and 80 million consumers, like I mentioned, we are able to collect significant indications from our consumers of what they're looking for when they're checking out, what types of payments that they might prefer when they're coming through, different shipping addresses. We might have expectations that their shipping addresses have changed or might be wrong, or there's better options for them. So we're able to pull all of this together and allow these large enterprise merchants to really have an experience that up until this point only folks like Amazon have been able to deliver. We now, with the layering on some of the AI tools that we're seeing, what we're able to put is even more actionable intelligence for those retailers and merchants to be able to say, what should I be presenting to this consumer right now, in sort of an adaptive real-time form.
But how do you go about streamlining all of that data? I mean, we're talking about over 80 million customers that you are taking this data, implementing it, and personalizing it in your checkout experience.
Yeah.
That's not an easy feat.
It's not an easy thing, and I think that what the big difference is that we see is that we're very focused on being able to provide that information to the individual merchants and retailers so that they can adapt their solution for the needs of their individual customers. High-end European luxury brand groups that we work with have very different requirements for their consumers and what they expect a checkout experience to feel like and look like than maybe a larger auto parts supplier that we're working with. The big thing that we're trying to do too is understand, with all of these insights on different consumers, what types of payments and what types of shipping methods they might be most interested in. So we can do something that's almost paradoxical, is we can offer a wide variety of choices of different payment methods, buy now, pay later, real-time payments, credit card, whatever it may be, but actually present the ones we think will be most relevant to those individual consumers, so they have a lot of options, but actually they're not forced to make a choice from a very long list. That's been revolutionary.
How has the e-commerce boom impacted your overall business strategy?
It's been really revolutionary, right? The last couple of years, we certainly saw a lot of stretch in people buying things online that traditionally they were going into stores, right? I think that there's a lot of people who order groceries now that are delivered to their house that never would have imagined doing it. Food delivered to their house that never would have imagined doing it before. What we're seeing now is that consumers have an expectation that they're going to have that same curated personal experience online that they used to receive when they'd go into their favorite restaurant or retail store when they were there. So that's really changed folks' expectations of what does it mean to be known? What does it mean to be known through the entire process? And we've been very fortunate as a company that we were well positioned to help to solve for that and provide that identity to retailers in such a seamless way that allowed them to own the relationship with their customers.
What are your top priorities for the rest of the year?
The biggest priority that we're looking at right now in 2025 is is around providing choice to consumers and to merchants in a way that's digestible and usable. A colleague of mine likes to give the example of a couple of years ago there was this trend of moving away from cable TV and into individual apps, for instance, on your home TV. And then that sort of emerged into, now we all have these various different logins to get to different apps, might have 2 subscriptions here or there. That same issue exists in checkout. There's been tons of innovation in the payment space with different buy now, pay laters, real-time payments, different card offerings. But what we haven't seen yet is someone coming together and presenting all of that to consumers in a way that's digestible behind one single identity. What I want as a consumer, and what I think we're hearing from a lot of the largest merchants that we deal with, is they want to provide to customers a single identity layer where behind that the merchant can provide all the relevant and best payment and checkout options to the consumer without that consumer having to worry about logging into different solutions or wondering which type of payment solution is best for them at that time.
Now we have a lot more to get to, including the opening bell coming up right after this quick break. Don't go anywhere.
How has this partnership propelled Snowflake's growth and deepened its ties to the broader financial and technology communities?
Well, you know this. The New York Stock Exchange is the most storied stock exchange ever on the planet, and we're thrilled and honored to be on it. But there's also a very deep collaboration between the firms. It's at the level of us being the data platform for ICE and for the New York Stock Exchange, and being an important distribution mechanism for all of the amazing data that the NYSE wants to share with its customers and partners. We get a lot of great feedback about where Snowflake should evolve from Lynn and her team. And things like the tree lighting and the judging are the icing on the cake that demonstrate how closely the companies work with each other to partner, but just as importantly, create success for all of our giant customers. It's a deep partnership that I'm very, very grateful for. I tell people that AI is already magical because these language models can do things like understand fluid language, like the language you and I are speaking, and make sense of it, extract context from it, and do that effortlessly. We knew that how people are going to consume information was going to be changed forever. Just like, back when the first smartphones came, most people in the world kind of simultaneously realized that there was a before and an after, that everybody was going to have these amazing devices with them. I think we're going to think about AI the same.
Good morning and welcome back to NYSE TV Live. I'm Kristen Scholler here in studio. And as we await the market open, NYSE-listed company and New York favorite SHAK is making its way to the Bell podium to do the honors. Trinity Chavez has more. Trinity.
That's right, Kristen. SHAK is actually a New York staple here for many around the city. NYSE ticker symbol SHAK, again, is celebrating a major milestone today. 10 years listed on the NYSE. CEO Rob Lynch, along with founder Danny Mayer, will ring the opening bell to mark the occasion. From their original goal of 450 locations, SHAK is now aiming for 1,500 with a focus on leadership, operational experience, and bringing the best fine casual experience to guests everywhere. So big things are on the horizon for this iconic brand, Kristen. And I have to say, I can't wait for this afternoon because I know that they're going to be outside Experience Square with Shake Shack burgers and fries and everything ready for everyone to come enjoy for lunch.
Oh yeah, Trinity, we hear the cheering here too. And let's take a look at that opening bell podium as Shake Shack is set to open the market for trade. I'm ready for a burger after that opening bell. Shake Shack here celebrating the open of trade on this Monday alongside the president of the NYSE, Lynn Martin. And let's talk stocks because the S&P 500 coming off back-to-back weekly gains, touching a new record high late last week. Joining me now with more is Jay Hatfield, CEO of Infrastructure Capital Management. Jay, welcome.
Thanks, Kristen. Great to be on.
Great to have you. And with the S&P near that record high, how does the market look to you at these levels?
Well, notwithstanding today's price action, it's not the greatest day in the market. We are bullish on the S&P for the year. We have a 7,000 target, mostly driven by just normal higher earnings, but also by an expected corporate tax cut down to 18%. That really increases earnings quite a bit. And we do think interest rates will moderate, which will support this pretty high multiple we're at right now.
We are getting ready to kick into high gear for this earnings season. Certainly the largest technology names reporting earnings this week, 4 of the so-called Magnificent Seven: Apple, Microsoft, Meta, and Tesla. Do you anticipate that the corporate tax cuts under the new administration will be the factor to boost earnings in the new year?
Well, we think it's a critical factor. Obviously, we do need momentum on tech. There's some questions about that. But the questions about the earnings are well timed because now we're going to get the real earnings in just a few days. So we think this sell-off's probably a little bit overdone. But to get that extra boost, so we would be 6,600 on the S&P without the corporate tax cut. You really need to get that done. And then there's more upside if we really did 15. Just seems to us there's too many competing interests, and corporate taxes never seem to really get brought up. They don't have a big advocacy. So we're trying to be reasonable, so we're confident in that 7,000 target.
Is there anything in particular, Jay, that you need to hear from the technology names this week on those earnings calls?
Well, I think particularly the chip and AI related companies, they need to address this threat from the Chinese. And I mean, our view would be there isn't any near-term impact from it, but they're the ones who really can sort that out for the market right now. We just have a little bit of a momentum sell-off from that. But like I said, it's really good timing because then we'll get the real data, real earnings, and real projections.
Speaking of real data, also coming this week is the first Fed decision of 2025 and a press conference, per usual, from the Fed Chair Jerome Powell. What do you anticipate when it comes to rates and what the Fed Chair might set up on Wednesday?
Well, we think, like most people, will be a hawkish pause. This Fed is mostly dominated by Keynesians. They don't really like Trump's policies, and so they think it's going to be inflationary. Thankfully, this isn't politics, it's economics, so we're going to get real data. We think the first quarter PC data will be really cool, and the Fed will cut 3 to 4 times, but they don't know that yet, so they're not going to say anything positive at this meeting.
So the Magnificent Seven represents, let's say, 40%, right, of the broader market. That's why we focus on these large technology names, especially when it comes to earnings. Underneath the hood, underneath that 40%, how do some of these other sectors look as we make our way through January?
Well, we do think that if we're correct about rates going down because inflation's cooling off, then you will see a rotation into the non-tech names, which is of course happening today. We have rates coming down. And we do think also that investors should look at bonds. We just launched BNDS, it's our bond fund, because it's like days like today where it seems always great to be all in tech, but then if your entire portfolio is getting demolished, it's better to have value names, dividend names, and then also some fixed income.
What is a return that an investor could expect on bonds this year?
Well, it depends on what class of bonds. So there's basically investment grade bonds and high yield, which includes preferred stock. So our fund's a high yield fund, has an 8 yield, so you can get higher returns, and they do better when the stock market's doing better. The other funds are more driven by treasuries. They can be a safe haven if things are really bad, but you tend to get more like 4 or 5% yields on those securities.
So a mix, it sounds like, of equities and bonds. What's a portfolio that you would perhaps advise to your clients or recommend to our viewers?
Well, most conservative clients have 20 to 40% bonds. But what we do counsel is to take a little bit more risk with those bonds so you get higher yields and higher long-term returns, even though you get a little bit more volatility, but you take less interest rate risk. So fully diversified portfolio, particularly for investors more conservative, maybe older, maybe closer to retirement.
A week today that President Trump has now been in his second term. What does that mean for investors?
Well, we think that reality will be less bad than fears. Keep in mind that well over probably 50% of big investors voted against Trump. So there's a lot of fears about what he will do. And so now we're getting the reality. It's going to be up and down. There's going to be a lot of announcements. But we do think that'll end up being positive. People will realize his policies are actually neutral to deflationary, not inflationary. So you get lower interest rates, more Fed cuts. So we are optimistic about the real data coming out versus the talking points from the election.
Jay Hatfield, CEO of Infrastructure Capital Management, joining me in studio. Jay, thank you.
Great, thanks, Kristen.
Great to have you. Well, up next, we'll talk data aggregation with the NYSE-listed company Similarweb. That's next.
Orbit is a space logistic company. Actually, we have been the first space logistic company in the world, a pioneer. What does it mean? Space logistics for us means taking care of customer assets in space, so satellites.
But what you're describing, it can't be easy. So talk to me more about how you go about optimizing in-orbit services while also reducing costs for your clients.
You can consider the launch vehicle, the rocket, as a bus, leaving each passenger at the terminus. Our satellite, our orbital transfer vehicle, that's the technical name, is released at the terminus together with other passenger. But our satellite has on board third-party passengers, small satellites on behalf of other companies. And if the rocket is a bus, we are Uber, taking each passenger to their respective home, which is the target orbit. They could do that on their own, which with traditional methods takes 6 to 10 months, thus wasting 1/3 on 1/4 of their operational life. We can do that in much lower time. So the result for the end user is getting to revenues earlier and extending the operational life of their asset.
There has been increasing demand when it comes to the utilization of space-based technologies. Talk to me about how D-Orbit is positioning itself from a business standpoint to keep up with the growing demand.
Besides the traditional standard services, we now see a big demand for something new, which is cloud computing in orbit. The quick, immediate need of
Welcome back to NYSE TV Live. I'm Trinity Chavez. Now, as a leader in web analytics, Similarweb is transforming how businesses understand consumer behavior and market trends. From AI-driven innovations to global expansion, to dive deep into the world of digital insights, I do want to bring in my next guest, Marta Solkeric. She is VP of Global Research Solutions. Marta, thanks for joining us today.
Thank you for having me. Good morning, everyone.
So for our viewers who might not know, can you give a brief overview of what Similarweb is and what it does?
Sure. So Similarweb is just the leading digital data company. We deliver very comprehensive, actionable, and trusted digital data, so to help companies at all sizes grow their businesses.
And how do companies typically use Similarweb to enhance their business strategy and their digital strategies?
So it really depends on the business model and the size of the company. So first of all, like a small company, small startups would usually use our intelligence platform to check any insights that would help them to grow. Larger companies would integrate our data into their models, like into their reporting systems, BIs, or the big tech companies would integrate our data into their LLMs just to train their large language models to make their digital products even better. But then it really depends on the industry because, the B2C companies would use our data to understand their market position, but also understand how they can grow, get to the top. The CPG companies would try to understand the marketplace performance, so their performance of their brands through the retail channels. B2B companies would try to use our data as a sales signals to find more companies, and investors would be using our data to understand and predict the performance of the B2C, B2B companies, just to be able to use it as a so-called alternative data company signals to predict their performance before the earnings calls.
Digital intelligence, though, as a whole, it's a very competitive landscape. Can you talk to me about how this specific sector has evolved in recent years, specifically the last decade?
So sure, that's like that's an amazing time because the demand for digital data has been growing together with the digital transformation, really boosted by COVID. So when we go back like 5 years, that was the time when the digital data was a very high demand. That was also soon after the time of our successful IPO, and many companies were just looking into the digital data to grow their business, and that was the time when many digital data companies were actually growing quite rapidly. Last couple of years, like a different scenario, the entire tech business, faced the interest rates increase and the profitable growth path. So it also opened many opportunities, a lot of market consolidation, merge and acquisitions, but also opportunity to go into the totally new spaces, to measure generative AI better, to go more bullish into the app intelligence.
And I do want to talk to you about the Digital 100 report that recently came out. Talk to me about what the key findings were and give a brief overview, too, of the significance of this report to our viewers who might not know.
Sure. So Digital 100 is ranking the fastest growing digital companies in the world, both in the web and in the app space, in well-established markets like US, UK, France, Germany, Japan, but also emerging markets like Brazil and India. And we've been publishing this report for 5 years now. And this is showing that digital trends, both consumer and market trends, and which companies were the most successful. And when you think about it, it could be the startup, it could be the very well-established company that is just doing the digital transformation or the app adoption right. But it also could be a totally new consumer trend that is just emerging as we speak.
And regarding the app and web usage, talk to me about what the fastest growing companies were in 2024.
So that's quite interesting because we see slightly different trends in the app and web growth, because also web and application is used sometimes slightly differently by the companies. So what was quite interesting to observe was the New York Times Games leading the big winners app ranking with the amazing success of the app. They have over 100% growth of the audience year over year, and that was not the traditional media business. So that was the gaming app that right now is surpassing the success of the other apps like Brawl Stars or other apps from the typical gaming industry. Best in class store reviews on the iOS, best in class stickiness. So around half of people use this app every day, which is absolutely amazing and best-in-class achievement.
Where do you see the broader landscape going for the rest of 2025 when it comes to the digital landscape?
Oh wow! So this is I think that many of the things of the future we just simply don't know, and we are all the time getting surprised. So look at what's happening with so-called TikTok refugees over the last couple of weeks. So the market is still surprising us, and we don't really know the trends. We know that for sure, brands need to be very demand responsive, using the most fresh data just to get on top of any market opportunity and consumer demand. But also, everybody should be aware of the ChatGPT and Gen AI disruption, which used to be used more for the professional use, adoption, but right now is also stepping into the consumer business, and we believe this is something to watch out moving to 2025.
Well, thank you so much, Marta Solkowicz, VP of Global Research Solutions at Similarweb.
Thank you for having me.
Now we have plenty more to cover here on NYSE TV Live, and we'll be back on the other side with more right after this short break.
So you work with many organizations undergoing digital transformation. What role does observability play, and where does Dynatrace fit in?
When you're going through a digital transformation, most likely you're going to change a lot of your digital estates. You're building new applications, you're connecting maybe a new mobile app or a new service to your to our backend systems, connected to AI systems. So the first thing you need to do where observability helps you is really understand your entire IT estate. What are you running? Which components or which applications are talking to others? What's working, what's not working? Because you're obviously going through this change, you're going to iterate over this environment and keep evolving it. That's one role that observability is playing. And once those services are then live and users are using it, observability helps you to optimize the user experience. I think just 2 days ago, when it was the British Airways outage, how do you feel at an airport if the service is not great? So observability does both. It actually helps you to understand how your system is working and how the individual pieces play together. And it also helps you to understand how users feel about your service, whether it's working for them. And then finally, if something goes wrong, and every now and then obviously something does actually go wrong, it helps you to find the issue quite quickly and helps you to also to resolve the root cause, or what the actual problem might be. Because as you can imagine, in complex landscapes, there's thousands, even millions of components, and observability and Dynatrace also helps you to pinpoint exactly where the problem is.
Now, Dynatrace has been working with AI for more than a decade. As the discussion regarding the cost of generative AI investments and ROI heats up, tell me, how is Dynatrace helping organizations to get the most value out of AI?
So we have a dedicated solution that we call AI observability. So we just talked about observability, now we're extending it just to the realm of AI, so helping understand how much.
Welcome back to NYSE TV Live, everyone. I'm Kristen Scholler. We continue to cover the stories of hope and support in the wake of the wildfires in Southern California. To that end, we want to highlight Dine Brands Global. It's the parent company of well-known restaurants like Applebee's and IHOP. And in the wake of the Palisades fire that broke out in early January amid powerful winds, Dine Brands offered free meals to firefighters and other on-duty emergency responders. Its donation spanned to the Los Angeles Fire Department Foundation as well. And in a LinkedIn post, Dine Brands wrote, quote, "A heartfelt thank you to all of the emergency response teams, especially those in Pasadena, our home base, for their incredible efforts on the front lines," end quote. Dine Brands' free meal donation extended through January 20th. After weeks of windy and dry weather, rain has fallen in Southern California as aid efforts are ongoing. Another NYSE-listed company is stepping up is Flutter. That's the parent company of FanDuel, and it's been a member of the Los Angeles business community for nearly 25 years. On January 10th, the company announced a donation of $250,000 to AmeriCares and the Los Angeles Fire Department Foundation. Amy Howe, CEO of FanDuel, said this, quote, "We are committed to ensuring our employees are safe and making sure the community has the resources it needs to support the heroic efforts of our first responders," end quote. FanDuel's AmeriCares donation will help the organization address urgent health needs in affected communities. For the Los Angeles Fire Department Foundation, that donation will go toward vital equipment and programs to save lives and protect communities. Our hearts continue to go out to those impacted. Well, as we focus on the future, one company is using scientific breakthroughs to advance humanity. And our Judy Shaw has more with the CEO of Exeger. Let's take a listen.
So Exeger is a Swedish deep tech company operating in the clean tech space. With deep tech, I mean a company based on fundamental scientific breakthroughs. We started with a small new nanoparticle. We developed that into components, into a new solar cell, and now we built 2 factories in Stockholm, Sweden. The factories run on renewable energy 100%, and the solar cell is a silicon-free, flexible solar cell. It works both indoor and outdoor. So actually, it's a light cell. It's not a solar cell. So it will take any kind of light, artificial light or natural light, shade, any kind, and convert it into electricity. That enables us to integrate this flexible film into a variety of products. So this is a product that we have developed together with 3M here in Protector. The headband is our solar cell. You never need to charge them. They will charge themselves, indoor and outdoor lights.
With customers in so many different sectors, from electronic shelf labels to hearing protectors you have here, can you tell me more about your core markets and your products?
If you look at business to consumer products, I can't quantify the saving in terms of money. But I do know that the largest pain point globally for consumer electronic products is battery running out. Pain point number 1, 2, and 3. People hate it. We all hate charge cables. We hate charge plugs. So by just knowing, okay, your headphones will never run out of battery, that's nice. It's convenient. I got 3 boys. They won't complain anymore on me. Dad, my headphones are flat again. Okay, it's not going to happen. And every time you don't charge in the wall and you allow Powerfoil to charge for you, you reduce CO2 footprint with 15 times. That's also good.
Giovanni, you were recently at CES where you received a lot of attention. What does that say about the trajectory of the company for 2025?
People are understanding that light is energy. If we can collect that light on a personal level without having a roof or a solar farm, we can utilize that. So we see many good things merging together now. And I think that's one of the main reasons that we see this very strong interest for Exeter. And it makes me happy. I've been trying to talk about this for many years, and now I think the world is catching up.
So finally, Giovanni, you mentioned the retail industry. What do you foresee happening in the coming years in that sector?
If you look forward 2, 3, 4 years, I think we're going to see the takeoff of the connected store. If we can integrate the good things from online shopping, all the insights you get online, into the retail sector, I think it's going to greatly enhance the shopping experience. Generating that data and allowing the value to come to the end users, like us, it's going to be massive.
Our thanks to Judy Shaw for that interview. Well, before we go, we have one more guest for you. This one combines shopping, technology, and the creator economy. And Trinity Chavez has more. Trinity.
Hey, Kristen, that's right. With creators becoming an essential part of purchase decisions, especially for Gen Z and millennials, LTK is at the forefront of revolutionizing this experience and social shopping. To share how the platform is empowering creators, building brand trust, and preparing for the changing social media landscape is Rodney Mason. He is the VP and head of marketing brand partnerships at LTK. Good morning, Rodney.
Good morning. Thank you for having me. Appreciate it.
So let's just dive right in here. The 2025 LTK Creator Marketing Study highlighted how much Gen Z and millennials rely on creators for purchase decisions. What do you think is driving this shift, and why are creators becoming such trusted voices for these generations?
Yeah, so if you go back to COVID times in particular, when consumers were shopping more on their phones, they were shopping more and more online, and they needed a trusted source. They had started following creators, but it really exploded then. And where it's gotten to today is they follow creators' lifestyles. So it's not just, oh, is this a good product to buy? It's much more about, I trust these creators. They simplify my life for me. And I can do it all on my phone very easily, especially through a source like LTK.
And the study also shows that repeated exposure to a creator's post increases the likelihood of purchases. How can brands leverage this insight to help build long-term relationships with consumers through those creators?
So we did a study with Northwestern University and spoke to 185 CMOs and really have insights from them and how they're targeting. And what they see and what consumers are telling us is that consumers do trust creators more than ads. And what has happened with Creator is it started in an area of specialization, particularly in social, PR, affiliate marketing, and now it's gone full funnel. So CMOs at the very top, including the media department and branding, are tapping into creators across all forms of media, not just social media, but they're using television, they're using in-store, they're using it as user-generated content because creators trust, or consumers trust creators even more than a typical shopper on a store site that provides a rating or review. So you're really seeing creator in all those places.
Yeah, it's really fascinating about the impact of creator endorsements and brand trust. Can you tell us more about how LTK is helping brands increase trust through creator content, especially on their websites?
Yeah, so with user-generated content, we work with the biggest retailers, all the retailers, almost all the retailers and all the brands. And it really started organically because they were seeing such high performance. They were testing creator against traditional ads and they saw excellent performance. Then we started showing them the research. And now if you go on a big retailer site, you will find creators demonstrating products, rating and reviewing them, even sometimes doing like live streams for brands and very specific products. The reason that consumers trust creators so much more for user-generated content is everybody has that experience where they see a product has almost 5 stars and then they click on the 1 stars and those 1 stars are like, this is terrible. I don't understand the discrepancy. But they feel like a lot of times that UGC content is not as authentic, but a creator has to actually build an audience, and that audience has to trust them, and they will not put out something.
No, absolutely. And Rodney, we have about 60 seconds left, but I do want to talk to you about how the social media landscape is shifting right now. Many consumers are looking for community elsewhere. How is LTK adapting to this change?
Yeah, so in our consumer study that we just did, 74% of consumers said social is not social anymore. And the number one thing they go to social for is to be social, to actually engage with the people they follow. And the algorithms are not working that way anymore. What LTK has done is we started as a community of creators, but now we've really enhanced our experience so that you get that full engagement experience. We've got video, we've got ways to communicate with creators, we've got all kinds of nice tools in there, and we've grown by the tens of millions.
Wow.
Right now, LTK is at 40 million monthly followers on average. Sometimes it's higher than that. And if you look at the population of Gen Z and millennial women in the United States, we have 38% of that audience. And then if you look at the income, we have the majority of the higher income customers who are coming to LTK as a social community, not just to make transactions from the creators they follow, but actually to engage with creators and follow new creators.
Wow. Well, thank you so much. Again, Rodney Mason, VP and Head of Marketing Brand Partnerships at LTK.
Thank you so much. Appreciate it.
Now, before we say goodbye, I do want to bring in my colleague, Kristen Scholler, as we wrap up the show. Kristen, I have to say, it was an action-packed day here at the Exchange.
An action-packed day indeed. There is a Shake Shack bus, truck, whatever you want to call it.
We're going to have to go out there for lunch and get our burgers.
Outside of the front of the New York Stock Exchange, indeed. If you're in Lower Manhattan, come by, get a burger. Of course, celebrate Shake Shack's listing here at the New York Stock Exchange and opening bell. It's going to do it for today's show, everyone. Thank you, as always, for watching. We'll see you back here tomorrow morning at 9 a.m. Eastern, right here on NYSE TV Live.
Thank you for being innovators in the market. Thank you for all you do every day to show the world what best in class truly means.
We are incredibly proud to join the ranks of other highly successful companies who partnered with this legendary institution.
What a time to be here. I am so proud of what we're doing. This is a huge milestone for our business. There's a lot of people responsible for getting to where we are today.
We have a role to play in bridging the gaps that exist today between us.
Not many people get to do something big in this world, and we get to do something truly special.
This is such a wonderful place to both look back and look forward. I'm so optimistic about what lies ahead. It has been a privilege to be with you.